Welcome to the exciting world of the stock market, a pivotal arena for modern investment and financial growth. If you've ever wondered where the magic of financial transactions happens, where fortunes are made and sometimes lost, that's the place. The stock market, a fascinating, pulsating entity that never sleeps, constantly evolving and driving the global economy. Let's break it down a bit. What exactly is a stock? Imagine owning a piece of a company, no matter how small. That's essentially what a stock is, a share in the ownership of a company. When you buy a stock, you become a shareholder, which means you now have a claim on part of the company's assets and earnings. But where do you buy these stocks? Welcome to the stock exchange, a marketplace where buyers meet sellers. It's like a supermarket, but instead of groceries, you're buying and selling shares of companies. The New York Stock Exchange, the London Stock Exchange, the Tokyo Stock Exchange, these are all platforms where stocks are traded. Now let's talk about market dynamics. The value of a stock is determined by supply and demand. When more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell a stock than buy it, the price goes down. This fluctuation is a daily reality in the stock market, influenced by factors like company news, economic indicators, and global events. The stock market plays a crucial role in the global economy. It allows companies to raise money for expansion and innovation, driving economic growth. It also provides individuals like you and me the opportunity to invest in these companies and potentially grow our wealth. Understanding the stock market is the first step in your investment journey. It's a world filled with possibilities, where patience, knowledge, and strategy can lead to remarkable outcomes. Remember, the stock market is a dynamic marketplace where companies and investors come together in the pursuit of growth. To navigate the stock market, it's essential to understand its basic components and mechanisms. It's like a bustling marketplace, but instead of buying and selling fruits, vegetables, or other goods, participants trade securities, including stocks, bonds, and other financial instruments. In the simplest terms, a stock represents a piece of ownership in a company. When you buy a stock, you're buying a little slice of that company, becoming a shareholder. Companies issue stocks to raise money for various reasons, such as expanding their business or paying off debt. Now, where do these transactions take place? That's where stock exchanges come in. The New York Stock Exchange and the Nasdaq are two of the most well-known exchanges in the world, serving as centralized locations where stocks are bought and sold. But you can't just waltz into a stock exchange and start buying stocks. This is where brokers come into play. Brokers are licensed professionals who buy and sell stocks on behalf of their clients. Today, many brokers operate online, providing platforms where you can trade stocks with just a few clicks. The price of a stock is influenced by supply and demand. If more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell a stock than buy it, the price goes down. It's the classic economic model of supply and demand in action. Moreover, the stock market plays a crucial role in the economy. It allows companies to raise funds for growth and expansion, and it provides individuals and institutions an opportunity to invest in these companies and share in their profits. However, it's important to remember that investing in the stock market also comes with risks. Stock prices can fluctuate, sometimes dramatically, and there's always the chance that you could lose your investment. Understanding these fundamentals gives you the foundation to start your investment journey. But remember, navigating the stock market is a continuous learning process. As you grow your investment portfolio, you'll gain more knowledge and experience that will help you make informed investment decisions. Now that you have a basic understanding of the stock market, you might be wondering, how do I start investing? First, let's talk about setting up a brokerage account. A brokerage account is like your bank account, but for buying and selling stocks. There are many online brokerage firms to choose from, each with its own advantages and features. Some offer free trades, while others provide extensive research and analysis tools. It's important to research and choose the one that best fits your needs and goals. Next, it's crucial to understand your risk tolerance. Risk tolerance is the degree of variability in investment returns that you're willing to withstand. Are you the type who can sleep soundly even if your investments lose value in the short term? Or do you prefer stability even if it means smaller potential gains? Your risk tolerance will guide your investment decisions, helping you choose between safer, lower return investments and riskier, potentially higher return ones. Now that you have your brokerage account and understand your risk tolerance, let's move on to the basics of buying stocks. Buying a stock means you are purchasing a piece of ownership in a company. When that company does well, the value of your stock rises. But if the company does poorly, the value of your stock falls. There are two main ways to buy stocks: market orders and limit orders. A market order is a request to buy or sell a stock at the current market price. A limit order, on the other hand, is a request to buy or sell a stock at a specific price or better. It's essential to understand how these orders work to effectively manage your investments. Lastly, and perhaps most importantly, is the importance of doing research before making an investment. This can't be overstated. You should understand the company's business model, its competitive position in the industry, its financial health, and its growth prospects. Additionally, keep an eye on the broader market and economic trends that could impact the company's performance. Investing is not about making quick, easy money. It's about making informed decisions and being patient. It's about understanding that there will be ups and downs, and being okay with that. It's about committing to a long-term strategy that aligns with your financial goals and risk tolerance. But don't let all of this intimidate you. Everyone has to start somewhere, and it's never too late to learn. There are numerous resources available to help you understand the ins and outs of investing. And remember, even the most seasoned investors started out as beginners once. Remember, investing is a journey, and every journey begins with a single step. Investing in the stock market is more than just buying and selling stocks. It's about having a strategy. Let's unpack this concept by first discussing the difference between long-term and short-term investing. Long-term investing is like running a marathon. You're not worried about the ups and downs along the way. Instead, you're focused on the finish line, potentially years or even decades away. This approach requires patience and resilience, as you hold on to your stocks through market fluctuations with the belief that their value will increase over time. On the other hand, short-term investing is more like a sprint. It involves buying and selling stocks over a short period, maybe a few months or even a few days, aiming to profit from small, immediate changes in stock prices. This strategy requires a keen eye for market trends and a willingness to take on more risk. Next, let's talk about the importance of diversification. Imagine your investment portfolio as a pie. You wouldn't want it to be made up of just one ingredient, right? The same goes for your portfolio. It should be a mix of different types of investments like stocks, bonds, and real estate from various sectors and geographical locations. This strategy helps spread the risk and can potentially lead to more stable returns. Finally, we'll touch on two analytical approaches to investing: fundamental and technical analysis. Fundamental analysis is like a doctor's checkup. It involves examining a company's financial health, its management team, industry position, and market competition. This helps you understand whether the company's stock is priced reasonably. Technical analysis, on the other hand, is like forecasting the weather. It involves studying past market data, primarily price and volume, to predict future price trends. This approach is often used by short-term traders. Remember, there's no one-size-fits-all strategy in investing. It's about finding what works best for you, considering your financial goals, risk tolerance, and investment timeline. With these basic strategies, you're well on your way to becoming a savvy investor. Let's recap what we've learned about the stock market and investing. We started by understanding the stock market, a dynamic and bustling arena where companies and investors meet. We learned about stocks, exchanges, and market dynamics, and how they form the backbone of economic growth. Next, we dived into how to start investing. We explored the process of setting up a brokerage account, the importance of understanding risk tolerance, and the basics of buying stocks. Remember, investment is not a sprint, it's a marathon. Finally, we looked at basic investment strategies. We discussed the differences between long-term and short-term investing, the importance of diversification to spread risk, and the pros and cons of fundamental and technical analysis. Investing in the stock market can be a rewarding journey, but it requires patience, knowledge, and a willingness to learn. So, are you ready to embark on your investment journey with these foundational strategies?